You are listening to Keystone's Stock Talk Podcast, episode 148. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week, we are excited to be announcing the launch of our next live webinar series entitled Summer School for Your Portfolio. I will give a preview of some advice on how to construct your portfolio to take advantage of long-term winners. Today, we also have two Your Stock Our Take segments. The first, Linamar Corporation, LRN on the TSX. The company manufactures powertrain and drivelines for vehicle and power generation markets. The majority of the company's revenues come from the vehicle segment, however. A listener asks us if it offers good value as a reopening investment with the economy continuing to open up once again. Our second question came in from a listener on a new IPO, or initial public offering. The company is ELMT Nutritional Sciences, symbol ELMT on the CSE. A Canadian nutraceutical company specializing in the development of science-based products for the global consumer packaging goods market, focusing specifically on men and women over the age of 50, the latter being Brennan's target market. The listener asks us about the company specifically, and also if we have any recommendations regarding what information we would typically like to know about a new IPO to make an informed decision regarding investigating or even following up on the stock as a possible future investment. Let's kick into the show. Aaron Brennan, I'd like to welcome you. Aaron, you were on Michael Campbell's Money Talks this weekend. How did that go?
Apparently I was. It went well.
You don't even remember. That's not a good thing.
Well, it just goes so quickly. I always feel that there's a lot more that I want to say, but you know, we packed as much as we could into the 15-20 minutes that I was speaking there, and I always have a good time. Michael is he's a great interviewer. I find it just really easy. I've done other radio programs or interviews where it's more awkward and it's difficult. It's awkward. Whereas Michael Campbell, he's a professional. He's been around for a while, and I just find his interviews always go smoothly. So.
Yeah, we both, speaking of just on a tangent, done interviews in the past where you'll send off, this is what we talk about, this is what we don't talk about. It's a good interview if we talk about these topics. If the other topics we're not going to really comment on. And, if you say we're not going to talk about, this is just an example, we won't talk about what the Fed did this week. And then you go into the interview and the first question is, so what did you think of the Fed this week? And you...
It's funny you say that because that was actually Michael's first question.
Yeah, well, I know, but we said we would talk about that with him.
But I was forewarned beforehand that I would have to put on my economist hat, and they know that that's not really something that I love to do. I don't like to make these big macroeconomic predictions or spend a lot of time diving really deeply into the macroeconomic framework, like what the Fed's going to do and where inflation and interest rates are going. We can have a sense of that. We always want to understand what's going on in the market, but we have always just found that spending too much time trying to make these predictions or forecast what a government or the Fed is going to do is just it's not a good use of your energy and time as an investor, especially as an individual investor. A lot of the time, actually, you really just become inundated and overwhelmed by the massive amount of information, and it can actually lead to paralysis by overanalysis, or equally as bad, or perhaps even worse, it could lead to overconfidence, somebody thinking that they know what's going to happen, they know where interest rates or inflation is going to go, and they build a portfolio that's based on this belief that they're able to predict the future. And I don't think that either of those courses of action are suitable for most investors. So we talked a little bit about that. I think Michael just wanted to know, what my thoughts were on, the Fed's decision, or the Fed's announcement rather, that they're planning on raising interest rates in 2023, starting in 2023. Of course, my response was, the Fed doesn't even know what's going to happen in 2023. They don't know what they're going to do in 2023. So how is a regular investor going to know and build an investment strategy based on that? So we just dove a little deeper as well.
So you didn't get out your big, bold economic predictions. Like, you do have that target on the Dow of 44,648.12 on January 11th, 2027, do you not? And it's based off of a Fibonacci sequence, isn't it? You do have that, but you just don't like to talk about it.
No, I like to keep that to myself,
Oh, geez.
Because
That's written on in that white room you go in sometime that's kind of padded, and you have that written up on the wall.
Exactly. I like to keep it to myself, partially because, I think it's a great investment idea, and also largely because I think people will think I'm crazy when I start investing based on the Fibonacci sequence.
Crazy. That's true.
It's my prediction is that we're not going to make predictions. My prediction is that whatever prediction the Fed is making or anybody else is making right now is not going to be correct, or what the consensus right now is not going to be correct.
And we have some things even in this webinar that we're doing. If you believe inflation is going to affect your portfolio, we will tell you, what type of stocks to be in that scenario. But they happen to be very similar to the type of stocks we would be in a non-inflationary environment. So,
exactly. And
but we'll get into that.
Yeah. And just for the strategy in terms of if you're not making these long-term predictions, then what are you doing? Well, I believe strongly, and it's what we've based our strategy at Keystone on over for more than 20 years, is that the best way to deal with an inflationary environment or any other environment is to have a portfolio of great companies, like really great businesses that are producing cash flow, that are operating in markets whereby we see a sustainable growth trend. That might be, sometimes that might be an essential, boring business. It's more like a infrastructure utility style. Sometimes it may be a more exciting, high-tech business in AI, Internet of Things, or cloud computing. And it's really going to range. And certainly in some types of environments, like if we go into a hyperinflationary environment, some of those areas are not going to do well. Others will perform better. And as well, if we don't go into an inflationary environment, same thing. Some industries may not do as well, but others will perform very well. But we really like to find companies where there's less of a dependence on commodity price or a Fed decision or government passing some spending bill. There's less dependence on that, and where these individual companies just have more control over their own futures. Of course, any business is going to have some exposure to events that are outside of their control, but some businesses are just completely what we would call, like, say, price takers. Commodity business, doesn't matter what your strategy is. If you're in a commodity-based business, commodity prices go down, it's very hard to grow your revenue and your earnings in that type of an environment. So we look for businesses where we see a sustainable trend that is not going to be necessarily impacted by a Fed decision, or a 1% or 0.5% difference in the GDP forecast. Just as an example, I'll just say cloud computing. Like cloud computing, we've had recommendations in that space. And that's an area that was absolutely essential during the pandemic. It was on a strong growth trend beforehand. And in the pandemic, I mean, if we all had to shut in like we did 30 years ago, I don't think the economy could have done that. But because we had, this higher level of digitization and cloud, we were able to essentially shift a lot online. So it was growing before, it grew through the pandemic. We think it's going to continue to grow. And then there's other types of businesses that are just, staple, boring businesses, like, maybe a power generator, a renewable company, or an infrastructure company that owns toll roads and ports and data centers. And it's really about getting a mix of these different types of businesses in your portfolio so that your portfolio is positioned to perform well in a variety of different economic scenarios. And that's the way that we invest. And then, of course, once you're, pinpointing these different areas you want to invest in, you also have to go through a lot of companies to determine, well, what is a good company financially in this space.
So speaking of helping your portfolio profit and do well in any environment, we're launching our next set of live webinars. Encourage all our listeners to attend that. June 29th, 7 p.m. on a Tuesday, 7 p.m. Pacific, 10 would be Eastern. And then on July 6th, it would be 4 p.m. Pacific and 7 p.m. Eastern time. It's called Summer School for Your Portfolio. Show you how to start with our simple time-tested strategy. No gimmicks, no games, just solid stocks really you'll get nowhere else, and how to avoid some of the landmines that exist in the current market environment. And there are many. Fears of inflation, we talked about that. High valuations, central banks endlessly printing money. You got meme stock distortion, and there's a fear of missing out in some areas. So how do you navigate through that? Well, whether you're just beginning your investment journey or you need a sober second opinion, we say that class is in section, and we'll have a section on Inflation 101, investing in inflationary environments, growth stocks versus value stocks. Are we seeing a reversal in 2021? We got some new age themes 101, which should be tech, AI, the digitization of the globe, really, renewables, clean tech, cannabis stocks, where the value is. Cryptocurrencies and blockchain, are these right for your portfolio? Healthcare trends, and some old school investments, 101. Commodities and cyclicals, are gold stocks right for your portfolio? Staple and essential businesses. We'll give you a portfolio tune-up. So if you're building a new portfolio from the bottom up, you're reviewing and repairing your existing portfolio, and give you some tips on portfolio maintenance. I think what a lot of people come for is our DIY starter portfolio. Provide detailed analysis, 5 to 7 new great stocks that you can buy for your portfolio today. To give you an example of the performance and why you may want to attend one of these events, in April of 2020, so just over a year ago, our DIY webinar recommended 6 stocks or 7 stocks, 6 or 7 in that range. The average gain was, at today's prices, 100.7%. So we've got some new unique businesses, profitable growth, and dividend stocks in this segment. Love to have you attend that, and love to see you, anybody at that event. We'll have a 45-minute Q&A at the end. Myself and Aaron answering any and all your questions on any stocks that we talk about there, or any you have in your portfolio and want a sober second opinion on.
It's exciting. I'm looking forward to it, and I think that I always like to refer to the best investment you can make, because you're investing in your own ability to be a better investor. And we've been doing this for over 20 years, and we'd like to help people, learn some of the lessons we've learned over that period of time.
I mean, the rooms online can take 500 people. We had 600 tickets sold last time. So, I mean, you always hear this, but it is good to get your tickets quickly. Anyways, we'll be talking about a number of things. I'm actually going to start off with one of the topics we're talking about. I'm just going to get into that a little bit of the topic that we'll talk about at the DIY, the webinar today. I talk about how 2 or 3 great investments can change your life. I'm going to give you a couple of quick examples of those now. Keystone, in 2008, we recommended a company called Boyd. We've talked about this many times, $2.30. It's paid out $5.50 plus in dividends. It trades in the $220 range today. That's over 10,000%. Now, we also, I'm going to relay a story. We talked about Boyd before, but at the tail end of the last decade, so around 3 years ago, around the time it became clear that Boyd would end up ranking as the best performing stock in Canada over that decade, we were asked many times, okay, so which stock will be the next Boyd? Now, we live in a world where it's, what have you done for me lately? We always hear that. You can find the best stock of the past decade, then everybody's like, what's the next stock for the next decade? So we always listed a couple of potential companies there. One of the higher ranking companies at that time was a company called Expel. It's then traded on the TSX Venture. While it has yet to eclipse Boyd over the past just under 4 years, it has rocketed from $1.40 to the $90 range. Again, not up 10,000% like Boyd, but 6,000 is pretty damn good. And that's in just under 4 years. So my question would become, and what you should be asking out there is, how do we find the next Expel? How did we find these companies? these type of businesses. How do we profile a business that comes out to be the next one of these for your portfolio? Now, let me be perfectly clear. These type of businesses are very, very rare. They're almost like what we'd call unicorns. So what we do is, though, we continue to utilize a strategy that gives our clients at least the chance to hit on one of these type of businesses in their portfolio. In fact, one of the segments, like I said in our live webinar, we will talk about how you can set up your portfolio to at least have a fighting chance of investing in or putting or getting one of these type of businesses in your portfolio. And just one can have life-altering effects on that portfolio. So there are two general elements to our process. First, we start off by looking over 3,500 companies in Canada. It's the most important part, and 5,000 plus in the US. Look for underlooked or underappreciated, great profitable businesses. And this is, again, the most important step. Without it, step two is really moot. It's a moot point. You don't need it. You don't even move to it. But step two is important, however, and that is our strategy on how to build your portfolio. How many stocks, what type of stock, and over what period you should be building that and maintaining your portfolio. So if you want to truly benefit from owning one of these game-changing stocks, I can first tell you what you shouldn't do, and that is build a portfolio in the traditional model. So it does sound controversial. Don't build it the traditional way. The big bank advisors will have you build your portfolio. It's really not that controversial because it's simple, and we've been detailing you why. If you build your portfolio that way, you cannot benefit greatly from owning one of these great businesses in your portfolio. So we first look at what the traditional portfolio model looks like. Well, you go to a big bank. The advisor drops your nest egg into about 5 to 10 or more mutual funds or ETFs, and that's essentially your portfolio. Now, if you want to mirror the market, the basic concept here is okay, but you don't need to pay an advisor 1 to 2% and pay 2+% on your mutual funds to achieve this. You can get 2 to 4 market mirroring ETFs, low-cost ETFs, spread out your dollars between that, and you'll be good to go. So you do not have to pay those fees, so you don't underperform. You'll just slightly underperform from the lower fees in those ETFs. But if you want to beat the market, which is why most of you listen to a podcast like this or become clients to Keystone, then if you buy 5 to 10 mutual funds or ETFs, which each own 100 plus stocks, you've set yourself up for failure. You'll mirror the market and, like I said, underperform due to those fees that you're charged. Even if a Boyd or Expel over the past decade happened to be one of the hundreds of stocks in those ETFs, it will make up maybe a quarter or a half percentage of your portfolio. That's not enough to make any difference in terms of wealth creation. But if you make it one of 15 to 25 stocks in your portfolio and use that profile, look at all the stocks in Canada, try to come up with great businesses, narrow it down, look at 3, 4, 5,000 companies, come up with 10 companies in a year, you have the chance of finding good, profitable businesses to put in your portfolio. So that will be one of the sections we'll talk about. I expand on that greatly and in more detail, but that's the type of kind of analysis that we're looking at in our upcoming webinar.
Now, correct me if I'm wrong.
Any final comments, guys, before we get to those? Sorry?
Definitely. Correct me if I'm wrong, but I believe in 2018, Expel actually was one of our DIY seminar recommendations. Now, again, correct me if I'm wrong, but even coming to one of those or coming to the webinar or
about
seminar.
the $5 range it traded at then, and it's $90. So I think for the $29 or $79 ticket, that investment, that's gone from $5 then to $90 in that range, I think that would have paid off that price of admission. I'm pretty confident in that. So those are the type of companies that we've introduced also after we've already had our clients introduced to these companies at the webinar. So again, we encourage you to attend and listen to us and we'll answer your questions there at the end. If you got any questions about any stocks that you have, if you just want a sober second opinion on 2 or 3 companies that you're looking at for your portfolio, attend that event and we'll answer your questions there. So let's get into our 2 Your Stock, Our Takes for this week. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. The first one is Linamar Corporation, LNR on the TSX. Got a question from this, and Aaron is answering that one, I believe.
Yes, you believe correct, Ryan. So Linamar Corporation, LNR, on the TSX, it trades at about $80 per share, and it's a $5 billion market cap company. So what they do is Linamar manufactures powertrains and drivelines for vehicle and power generation markets. The majority of the company's revenue comes from the vehicle segment. The company has over 26,000 employees in 61 manufacturing locations globally. I do think that Linamar is an interesting story right now. The company primarily services the auto sector, which is cyclical, and this is evident when you look at the company's historic financial performance, with revenue growing and declining in line with global auto sales and demand. The reason I find this company interesting is because after 2 years of consecutive revenue declines, it appears that 2021 may be a year that they return to growth for the company and the industry. Demand for autos right now is strong. COVID-19 hit the industry hard, so there is some pent-up demand as the economy is reopening. However, even relative to 2019, demand in 2021 has been higher. There's also the transition to electric vehicles, which further supports demand over the next several years. So 2020 was a weak year for Linamar overall, but the company did produce double-digit revenue growth and more than doubled its earnings in the first quarter of this year. Revenue for Q1 increased 15%, and earnings per share for the quarter were $2.41 compared to $1.04 in the previous year. Analyst consensus for the company right now is earnings per share of $7.60 for the current year, 2021, growing to $8.25 in 2022. This puts the valuation at right about 11 times analyst consensus for 2021, which is certainly a discount to the overall market. The balance sheet appears healthy with debt to equity of 0.2 and debt to EBITDA of less than 0.3 times. So overall, the fundamentals of Linamar look strong, and the stock price is only moderately above where it was just before the start of the pandemic last year. The valuation right now certainly looks inexpensive. This isn't a company that I am personally extremely familiar with at this point. The yield is only 0.8%, so it doesn't really qualify for a Canadian dividend research. The yield just isn't attractive enough. This is also a cyclical company, and typically we like to purchase companies where we have a better feeling of where the trend of earnings and revenue will go over the next 3 years. However, as I said, it does look like 2020 year may be a return to growth for Linamar and for the industry. And given the strong balance sheet and the valuation, there's certainly something that we can dig into here. It's an interesting business, and I look forward to researching it further.
Very interesting.
Yeah, it's a good summary on the business, and it is one, if they're, as far as a reopening trade, it's an area that we're looking at. We have one company at the start of this year that, services the auto parts industry that we do have a recommendation on, has a really clean balance sheet, a net cash position, but and pays a little bit higher yield, about quite a bit higher, 3.8% yield. Smaller business, but good, offering decent value right now, and ours already moved up this year, which is nice to see, and we could see continued growth from that business as well. And our clients will know that business well. Let's move to our next company. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Brennan, you're going to take that one. It is a new IPO. It's ELMT Nutritional Sciences Inc, ELMT on the CSE. And you also had a question there about in regards to what we would look at with a new IPO in terms of making an informed decision on whether it may be a potential investment now or in the future.
Exactly. So I want to go a little educational here. I did receive this question actually came in from a client. I'm going to keep his name secret. But I thought it was a good question, and I recently answered it.
And before you get in, can you confirm that is your target market, though? The market that I spoke of?
Yeah, sure. We could go with that. That
You're
is my...
speechless. All right, just go.
Brennan neither confirms nor denies.
Exactly.
Yeah. The poor guy.
Always getting beat up. But no, it's fun. It's fun. It would be boring if I wasn't. Okay, so like I said, this came in from a client. He's basically asked two questions. He says, I was hoping you could tell me what you know or think of Element Nutritional. And then he also says, do you have any recommendations regarding what information you would typically like to know about a new IPO to make an informed decision regarding investigating or even following for possible future investments? Well, first off, I'm going to answer that second question. For any business, regardless if it's an IPO or has been publicly traded for a long time, the general checklist that I look at to justify an investment include a good runway for growth, generally looking at revenue and profitability. I want to see some growth going forward. The second point is profitability. This is either, the company generating net income or adjusted EBITDA. Now, the third point is the company has a reasonable valuation. This is either looking at the price to sales multiple, price to earnings multiple, or, the enterprise value to EBITDA multiple, which we typically use. And then the fourth point is having a healthy balance sheet, which means essentially, cash on the balance sheet and not too much debt. So keeping those in mind, we will come back to those and kind of see how this company checks those off. So Element Nutritional Sciences Inc, ELMT, on the CSE, currently trading at a price of around 73 cents and has a market cap of just under $70 million. Now, as Ryan said, Element is a Canadian nutraceutical company specializing in the development of science-based products for the global consumer packaged goods market, focused specifically on men and women over the age of 50, and like Ryan said, the latter being my own target market. Just kidding. But yes, so the company's flagship product is called Rejuvenate, and essentially this is an organic plant protein drink, and it also offers Jack TRX, which is a brand of performance supplements. So looking at a few key points here, the company did IPO on the Canadian Securities Exchange at a price of 88 cents on May 26, 2021. So it is a little bit down from that IPO price. Element recently completed a $5 million private placement on June 4th for approximately 8.3 million shares. And I did include those shares in the market cap that I referenced before of just under 70 million. And as well, the company's products are gaining decent traction now in about 15,500 locations in the US, 750 locations across Canada, and multiple e-commerce platforms. And a few of these recent deals include getting into 8,400 Walgreens across the US, and then also receiving purchase orders from Sam's Club e-commerce platform and iHerb, which is also another e-commerce platform. And the company expects Rejuvenate, so their flagship product, to be available to order in July of 2021 on both of these online channels. So now that I've given you guys some background on the business, let's take a look at the recent financials for Q1 of 2021. Now, revenue growth does appear good when we first look at it, but keep in mind the comparable period last year was weak due to COVID. But anyways, over the period, revenue did increase about 95% to $345,000. Now, the company is still losing money. They have a net loss for the quarter, which was approximately $1.5 million. But about $400,000 of this was from increased professional fees as the company went public, but still, they're still losing money. Now, looking at the balance sheet, if we include the recent $5 million equity raise that I brought up before, it does appear healthy with a net cash position after leases and debt of approximately $3.9 million. And if we annualize the company's most recent Q1 2021 revenue, it is currently trading with a price to sales multiple of about 50 times, which is expensive. But keep in mind, the company has recently gotten into some new sales channels, as I said, but it is of my opinion that even with the new revenue from these deals, I still believe the price to sales multiple will be pricey. And nonetheless, without forward financial guidance, including these additional sales channels, we are still sort of in the dark and must speculate if we are paying or if we're getting a good deal or not for the price that it's trading at right now. So, reverting kind of back to the 4 points that I talked about before, let's go through, those investment checklists that I proposed and see how this company stacks up. So number 1, does the company have a good runway for growth? Now, I personally think that we can provide a check mark here. The company is getting into new locations, but we are still a little uncertain if the product will sell through in its new channels. But nonetheless, I'm going to give it a check mark here for the number 1. Now, number 2, profitability. So looking at net income or EBITDA. Now, unfortunately, on both a net income and adjusted EBITDA basis, the company is still far from profit, so we can give the company an X here. So far, the company is 1 for 2 here. So looking at the third point, does the company have a reasonable valuation? Well, like I said, on a price to sales basis, I think the company also deserves an X here, with it trading at 50 times annualized Q1 2021 sales. Going forward, this might change, but like I said before, I personally speculate that once these sales channels come online, I still think that the company will be generally pricey. And the last point here, does it have a healthy balance sheet? Well, right now, I'm sort of conflicted for giving the company a check mark here, but although it has a net cash balance or net cash position right now due to the recent $5 million equity raise, the company is not profitable and has a cash burn rate of approximately $1 million per quarter. So seeing this, I am only going to give the company half a check mark here, because they're probably going to have to raise money in the future and burn through this cash. So with these 4 basic criteria for investment that I listed, only 1.5 of these 4 conditions have been met. And even I wouldn't even say that they've fully been met. There's still some questions that come into my mind. So essentially, ELMT wouldn't meet our investment criteria. It's certainly an interesting company with decent traction. They're getting into new stores, but it's operating in a very competitive space and is essentially just too speculative right now for our liking.
Yeah, I think that provides an excellent summary of kind of how we would look at that business. We continue to monitor it. We monitor all new IPOs that come onto the market. It's really, the revenue growth is coming off that low base, looks solid, but it's still really a small revenue base that we're looking at. Anything under like $1 million on a quarterly basis. I mean, even $1 million on a quarterly basis is very small. So, we'll continue to monitor if the growth continues out of the pandemic. It's certainly in a hot segment, and if it can start to produce cash flow, those are things we'd like to see. So those are things we look at when we look at a new IPO or any business.
Yeah, and I just kind of wanted to, include those checklists, because, that is also something that Ryan is going to, kind of touch on in the upcoming webinar, how to, analyze a business for yourself. So, I just kind of wanted to give people kind of a little bit of a taste, because, it is just a simple, checklist essentially of, going through the list and seeing if you want to invest in the company.
Yeah, and I'll give you a simple 5-6 steps to analyze any business. You get a hot stock tip out there, like, we get these questions on these companies all the time. I'll tell you how you could go and take 5 or 6 steps and figure out whether this is pure speculation or potentially investment worthy. There's obviously other steps you have to take to really plop down your dollars, but you can quantify that hot stock tip as either investment worthy or just pure speculation. So if you are going to invest in that company, what type of money? Is it play money, or is it really some investment that I want to grow over the next 1 to 10 years, right? Like, it's a totally different type of investment once you quantify it, either way. So I think that's going to end our show for this week. We're really excited next week to have our upcoming live webinars, Summer School for Your Portfolio. Love to see any and all of you there. And as always, keep your questions coming into our Your Stock, Our Take segments, or Ask Us Anything. We'll do a debate on individual companies as well if you want us to look at 2 in the similar industry, or 1, we'll just argue whether or not it's a buy or sell on both sides of the argument. As always, I wish you profitable investing and look forward to seeing you next week at our live webinar.
Profitable investing. Thank you.
Thanks, everyone.